Hi everyone, welcome back to Saheb Academy. Today in this ninth video of buyback chapter, we're going to solve this illustration 4 from the ICAI study material. But from our series, this is our seventh problem, and this is a very interesting question we have over here, because this question is not just of the buyback of shares but also of redemption of preference shares, ESOP, as well as redemption of debentures. Okay, so this becomes a very special question because lots of things are involved over here. It's a mixture question, so you have to understand this properly. Okay, so let's begin. Let's just go through the question and let's understand what is being said over here, and then we'll solve this question. Now see here, illustration 4. Extra Limited, a non-listed company, furnishes you with the following balance sheet as at 31st March 2021. So here we have been given the balance sheet, and in brackets over here they have written in lakhs. In lakhs means that all the figures that are given over here are in form of lakhs. This 4 doesn't mean 4 rupees. No, it means 4 lakhs, 120 lakhs, like that. Is that clear? Simple. So see the balance sheet. Share capital 120 lakhs. Note number 1, let's see. We have equity share capital as well as preference share capital. 100 lakh equity share capital and 20 lakhs preference share capital. Equity share face value is rupees 10 and preference share face value is rupees 100. Fine. Next we have reserves and surplus, 118 lakhs. Note number 2, let's see what all reserves we have. See, capital reserves 8 lakhs, revenue reserves 50 lakhs, which is a free reserve, and then securities premium 60 lakhs. In total that's 118 lakhs. Clear? Easy. And then long term borrowings 4 lakhs, so that's note number 3, 10% debentures 4 lakhs. Okay, and then we have trade payable 70 lakhs. Fine. PPE 50 lakhs. Fine. And then non-current investments of 120 lakhs, and then we have cash and cash equivalents of 142 lakhs. Clear? Easy. Now let's just see the additional information what has been said over here. See here, in the first point they are talking about redemption of preference shares. See, the company redeemed the preference shares at a premium of 10% on 1st April 2021. Okay, all the preference shares have been redeemed, okay, at a premium of 10%. Fine, we'll do that. And then the second point, see, it also bought back 3 lakh number of equity shares of rupees 10 each. Okay, 10 is the face value at rupees 30 per share. 30 is the buyback price, so 20 is premium, isn't it? If 30 is the buyback price and 10 is face value, then the remaining 20 rupees is the premium on buyback. You all know that. Yes, the payment for the above was made out of huge bank balance. Okay, that's fine. The third point, see, included in its investment, so they are talking about this included in its investment. They're talking about this 120 lakhs. Yeah, in that 120 they are saying there is investment in own debentures costing 2 lakhs. Okay, in this 120 there is 2 lakhs which is investment in own debentures, face value 2.2 lakhs. Okay, face value of the debentures they are talking about, it's 2.2 lakhs. These debentures were cancelled on 1st April 2021. So here they are talking about redemption of debentures. Okay, there are many methods of redeeming the debentures. Now here they are specifically talking about purchase in open market. Yeah, whenever the price of the market value of the debentures considerably fall in the market, then what the companies do is they purchase their own debentures. If they want to cancel, then they purchase their own debentures and cancel them. Okay, already the company will have a liability in their balance sheet. Yeah, 10% debentures. Now they have purchased. Now here you don't have to purchase, already it's existing in investment. They have purchased and all. You just need to cancel here. In this third point, you just need to cancel. Okay, so they will have the liability, and when it's purchased there will be an asset also, investment in own debentures. So then these both things will be set off. Okay, that's what happens in this concept, purchase in open market. But here you just need to cancel, that's all. Okay, fine, we'll see how it's done. Okay, don't worry. And then the fourth point, see here, the company had 1 lakh equity stock options outstanding on the above mentioned date, that's 1st April, to the employees at rupees 20 when the market price was rupees 30. Okay, here they are talking about ESOPs. Fine. So 1 lakh ESOPs were there outstanding on 1st April to the employees at rupees 20. 20 is the exercise price. Okay, 20 is the exercise price when the market price was rupees 30. So if market price is 30 and exercise price is 20, which means that the employees can subscribe to the shares of the company at rupees 20. So the employees are getting a discount of how much? Of rupees 10, isn't it? Isn't it? So this is called as value of option in this chapter, in ESOP chapter. Okay. So now this was included under current liabilities. What was included under current liabilities? This 10 rupees. Okay. This value of option now, this is an expense. Yeah, this is a discount which the company has given. So at the end of every year, the company will be booking the expense of this value of option, and as well as they'll be transferring this to a special account called as ESOP outstanding account. Okay, is that clear? Yes. So that's what they are saying. This was included under current liabilities. Okay, in the current liabilities it was included. Is that clear? Yeah, here in the 70. Clear? Okay. And then they are saying on 1st April 2021, employees exercise their options for 50,000 shares. So on 1st April, the options were exercised and 50,000 shares were subscribed. Is that clear? Okay, so this is the ESOP. So we'll see all this. Don't worry, pass the general entries to record the above. Prepare balance sheet as at 1st April 2021. Okay, fine. We'll do all these things. Okay, so now let's start with the first point. In the first point, what we have to do, we have to redeem the preference shares. So let's just see the equation now. See, it's really simple. You already know preference share capital plus premium is equal to preference share holders. Yeah, this is the equation we always prepare. We all know preference share capital in the balance sheet is of how much? It's of 20 lakhs, right? So 20 lakh is the face value, right? And the premium is 10%. So 10% of 20, that's 2 lakhs. Clear? So in total, how much we have to pay to preference shareholders? 22 lakhs, isn't it? Yes. Now first let's talk about the replacement of capital that can happen through either fresh issue or creation of CRR from the free reserves. Do we have any free reserve in this question? Of course we do. We have revenue reserve, isn't it? I showed you we have revenue reserve of 50 lakhs. Okay, and the question has not said anything regarding fresh issue of preference shares or equity shares, right? So we'll not do anything regarding fresh issue by our own. No, we'll not do that. Okay, so just CRR. Clear? So 20 lakhs from revenue reserve will be transferred to CRR. So revenue reserve will be decreasing by 20 lakhs and CRR will be increasing by 20 lakhs. Okay, so then the capital is being replaced. Okay, fine. And then come to the premium. Okay, premium 2 lakh. This premium 2 lakh has to be written off. Yeah, we have to write this off, isn't it? When we studied redemption of preference shares chapter, we saw there that we can utilize only free reserves to write off this premium, isn't it? They said that the companies are following section 133 and those companies are not permitted to use securities premium, isn't it? Yes. So now here the question has given you a hint that it's a non-listed company. So we make an assumption that this company is not governed by section 133 of the Companies Act, and we are utilizing securities premium because we don't have any other free reserves left. Okay, that's why. So here in this question we have to use securities premium to write off premium on redemption of preference shares. Is that clear? So we utilize securities premium. Is it clear? Yes, we do have revenue reserve. See here, we do have revenue reserve of remaining 30. Yeah, from 50 we utilized over 20 over here, but that remaining 30 we need for buyback also now to create CRR. So that's why apart from that, now we don't have any other free reserve. Is that clear? So that's why here we had to utilize securities premium. Is that clear? Simple. So this is the redemption of preference shares. Yeah, everything is over regarding that, and then at last we'll make the payment. Fine, easy. Next we have, what do we have next? Next point is of equity share buyback. Yeah, it also bought back 3 lakh number of equity shares of rupees 10 each at rupees 30 per share. The payment for the above was made out of huge bank balance. Now let's do the equation of this. Okay, once we do the equation, then easily we can pass the journal entries. Passing the journal entries is nothing. Okay, see here, buyback, equity share capital plus premium is equal to equity shareholders. The face value of equity share was rupees 10. The premium was rupees 20. How did we got to know premium is rupees 20? Easily. See, they told us 30 rupees is the buyback price. So easily we can understand remaining 20 is premium. Fine. So 3 lakh into rupees 10, that's 30 lakhs. 3 lakh into rupees 20, that's 60 lakhs premium. Okay. In total, we will be paying 90 lakhs to equity shareholders. Fine. So here also the question was silent regarding the fresh issue. Nothing has been said. So we will not do any fresh issue by our own. Okay. Fine. We'll be only creating the CRR out of the free reserves. Fine. So we utilize the remaining balance of revenue reserve. Here we utilize the revenue reserve by 20 now while doing the redemption of preference shares. So the remaining balance that is left in revenue reserve was how much? 50 minus 20, that's 30 lakhs. So only 30 lakhs was remaining. So that 30 lakhs we will utilize over here to create the CRR. Is it clear? Is it clear? Simple. Fine. So revenue reserve here decreased by 30 and CRR increased by 30. So in total right now, after redemption of preference shares and now this, we have 50 lakhs in CRR and revenue reserve is no more. Okay, revenue reserve is completely finished. Is that clear? Simple. Okay, and then come to the premium on buyback. Now premium on buyback, we can utilize free reserves as well as securities premium. Companies Act permits that. Okay, you can utilize free reserves such as PNL, general reserve, revenue reserve and all, and as well as securities premium. But this thing is not allowed over here. Okay, this thing is not allowed over here. Okay, but here it's allowed directly. So we'll utilize the securities premium by 60 lakh by 60. Okay, 60 lakh premium was there and we utilize the securities premium completely. But now understand, see here, let me just show you. In the question, securities premium was only of 60. Yeah. So how can we use securities premium by 62 lakhs? Here 2 lakhs and here 60 lakhs. How can we do that? Don't worry. When we'll do the ESOP now, when the exercise entry will be passed, at that time we will have securities premium. Okay, we'll be getting securities premium. Is that clear? Okay. So that's the thing. Fine. So this is the buyback. Okay. Capital is being replaced by this CRR, and then here you have written off the premium on buyback through securities premium, and then you will be making the payment entry. Okay, is it clear? Simple. Now let's just see debentures. Okay, included in its investment were investment in own debentures costing 2 lakhs and face value is 2.20 lakhs. Okay, so see here it's really simple, nothing is there. Investment in own debentures, 2 lakh was the cost. Okay, 2 lakh was the cost and 2.20 lakhs was the face value of the debentures. This is the face value and this is the X interest price. This is the cost, just the cost. Okay, so the difference between those two, when you will cancel them, the difference will be profit. Yeah, face value is more than cost. So of course, you have paid less to acquire more debentures. Yeah, more value of debentures. So that's why when you will cancel, there will be profit on cancellation of 0.20 lakhs, which is 20,000. Isn't it simple? Easy. Okay, so now how will you cancel the debentures? Do you know the entry? It's really simple. See here, investment in own debentures account is an asset account, right? It's there in the investment, this non-current investment. So you will credit the investment by how much? By 2 lakh, and you will debit the 10% debentures. You will debit the 10% debentures by how much? By 2.20 lakhs. Okay, 2.20 lakhs debit and 2 lakhs credit, and then the balancing figure of 0.20 lakhs or 20,000 will be profit on cancellation. Exactly, we'll see the general entry, don't worry. Fine. So that's regarding the investment in own debentures. Okay, the redemption of debenture, this thing. And then we have ESOPs. Okay, let's see the ESOP now. It's really simple. See here, there were 1 lakh total ESOPs in the question. Market price, they told us it was rupees 30, and X interest price, the price which was offered to the employees, was rupees 20, the discounted price. Yeah, and then the difference between those two is the intrinsic value, or you can call it as value of option. Okay, rupees 10. This is the discount that has been offered to the employees, right? So this is an expense, a kind of a loss to the company, right? So this expense is being recorded every year, at the end of every year in the company, okay, in the company's books. And together they also record a liability. Okay, they also record a liability called as ESOP outstanding account, because you know there will be a vesting period, right, in ESOP, right? 5 years, 3 years and all. So at the end of every year, what will be happening? They will be recording this loss and nothing will be given at that time. Yeah, the shares will be given only in the exercise period after 5 years or after 3 years. So in this 3 or 5 years in between, the expense will be recorded and a liability will be recorded. Okay, these two things. Fine. The expense will go to profit and loss, right? But the liability will keep on getting accumulated in the balance sheet, right? And then at the end, when the when the ESOPs are exercised, when the employees subscribe to shares by utilizing their right, then what you have to do? What you have to do? In the question, they have told you that 50,000 shares will subscribe, right? So what you have to do? When the shares are subscribed, what will happen is you will receive money, okay, 50,000 into 20, isn't it? This is the price now. X price is the price that the employees will be paying to you, to the company, I mean. So 50,000 shares into 20, that's 10 lakhs. So 10 lakhs money will be received by the company, okay? And then this ESOP outstanding account which was there, and they are saying it was there in the current liability, yeah, they have recorded it over here. So this you will have to cancel. How do you cancel the liability? You will debit that ESOP outstanding account, debit, okay? And always remember, this account plays its game on value of option, okay? So 50,000 shares into value of option into 10, that's equal to 5 lakhs. Is it clear? Is it clear? Okay. And then shares will be given to the employees, right? So you will credit equity share capital, okay? And that's face value only, always 50,000 into 10, 5 lakhs, okay? And then whatever balancing figure will be there, that will go to securities premium. Fine. So securities premium over here will be 20 rupees, isn't it? 10 rupees is the face value, 30 was the market price, so 20 is the securities premium, okay? 50,000 into 20, 10 lakhs. Is it clear? This is the ESOP concept over here. When the options are exercised, always remember, you will receive the money, you will give the shares, right? So shares will be given here, face value and securities premium will be there, and then you will cancel the ESOP outstanding, that account which you prepared now, which was getting accumulated over the period of all 3 or 5 years, whatever it is, the vesting period. So that you will have to cancel. Is that clear? So now let's just see the journal entries one by one. It's really simple. Let's go to the journal entries. Okay. Now see, here we have the journal entries. First, let's just talk about redemption of preference shares. The first entry is the due entry. Preference share capital plus premium is equal to preference shareholders now. So what you have to do, you have to cancel the capital by debiting it. 9% redeemable preference share capital account, debit 20 lakhs, okay? And then you will debit the premium on redemption of preference shares account, debit. Why? Because this is a loss to the company, okay? All the losses are always debited, okay? It's an expense, it's a loss. Fine. So 2 lakh will be debited, and then to preference shareholders. So you will credit this personal liability to preference shareholders, 22 lakhs. You will accept as a company that you have to pay 22 lakhs to preference shareholders. Fine. So that's the first due entry. And then the second entry is creation of CRR. Normally we pass this entry, yeah, but this entry will pass at last after the ESOP entry, because we don't have enough securities premium balance, okay? That's why we'll be passing this entry at last. Fine. Okay, so now let's just pass the entry of creation of CRR. How do you create any reserve? Just by crediting that. Yeah, you know now what is happening over here. Revenue reserve is decreasing, so debit that, and CRR is increasing, credit that. Revenue reserve account debit 20 lakhs to capital redemption reserve 20 lakhs. Simple and straightforward. And then you will be making the payment to preference shareholders. Here you credited to preference shareholders. Now you will cancel that liability by debiting it. Preference shareholders account debit, because you are paying them off. So they can't be so they can no longer exist in the books. So you are debiting and cancelling them off to bank account 22 lakhs. Is it clear? Simple. Next we have to see buyback. Okay, see, buyback is also kind of the same thing only, right? The first entry is the due entry, this equation only. Equity share capital you will debit and cancel. Premium you will record because it's a loss, but you will record by debiting it, and then you will accept as a company that you have to pay to equity shareholders account, equity shareholders account or equity share buyback account. Okay, so see here, equity share capital account debit 30 lakhs, premium on buyback account debit 60 lakhs, to equity share buyback account 90 lakhs. Clear? This is the due entry. Fine, 30, 60, 90. Yeah, and then you will write off this premium on buyback. Yes, so how will you write off premium on buyback? It's really simple. Here it was debited now in the due entry. Now you will credit the premium on buyback to cancel it off. That's how you write it off. Okay, and the debit will be securities premium. By how much? By 60. Here it was 60 now, so 60. Securities premium account debit 60, to premium on buyback account 60. Is that clear? Simple. And then replacement of capital. There was no fresh issue. There was only creation of CRR. So CRR is increasing by 30 and revenue reserve is decreasing by 30, right? So that's the entry you will be passing. Revenue reserve account debit. You have decreased the revenue reserve by debiting it by 30 lakhs, and you have credited the capital redemption reserve by 30 lakhs. Now in the study module, in the study material, if you'll see, they have combined these two entries. Which two entries? This one and this one. They have just passed one entry of CRR by 50 lakhs. That's also fine. But I have expanded everything and showed you clearly how it is. Okay, it's same only, it doesn't matter. 20 lakhs, 30 lakhs, the same effect is there. Ultimately at the end in the balance sheet, CRR will be of 50 lakhs and there will be no longer a revenue reserve. Revenue reserve is completely zero. Is it clear? Okay, fine. So creation of CRR is over, right? Capital is being replaced, and then we'll be making the payment to equity shareholders. Yeah, here you accepted as a company that you have to pay to equity shareholders, right? Here you credited equity share buyback account. Now you have to debit that account over here, equity share buyback account, and pay them off. Yeah, you have to cancel that liability. Equity share buyback account debit, that liability has been cancelled, 90 lakhs, and you have made the payment to bank account 90 lakhs. Is it clear? Simple and straightforward. So right now we are done with redemption of preference shares and equity share buyback also, right? It's just that this entry we have not passed. Which one? Securities premium. So we'll pass that, don't worry, after the ESOP. Okay, so now let's just see of debentures. Okay, so see here, it's really simple. See, what did I say? Investment in own debentures, two things were involved over here. One is asset and the other is liability, right? So asset is of 2 lakhs. Okay, the asset is of 2 lakhs and the liability is of 2.20 lakhs. The face value of which we are cancelling right now is of 2.20 lakhs. So when we cancel, the profit on cancellation will be of 0.20 lakhs. Okay, so see here, 10% debentures account debit 2.20 lakhs. Okay, this is the liability we are cancelling. Okay, debenture liability, the face value, and we are crediting our investment account because we have purchased our own debentures and that has become our asset. So to cancel the asset, what we have to do? We have to credit. Yeah, debenture is a liability. To cancel, you have to debit. Asset has debit balance, so to cancel, you have to credit. Fine. So 10% debentures account debit 2.20, to investment 2 lakhs. So the difference between those two is 0.20. So that's profit on cancellation of own debentures. Now why profit is being credited? You all know now, revenue, gains and all incomes, what do? You credit them to record them, isn't it? Whenever revenue increases, what do? You credit that. Fine. Okay, fine. So that's the redemption of debentures over. Now let's move on to the ESOP. Now here the same entry you will pass. Okay, what is happening? The first thing is you are receiving the money. Yeah, when the options are exercised, it's not for free. Okay, it's not for free. We will receive the money. We will receive the money on the basis of exercise price, not on the market price or value of option. No, on exercise price, because this is the price that is being offered to employees. They will subscribe to our shares at this price, at rupees 20. So you will debit the bank account by exercise price. Okay, so see here, bank account debit 10 lakhs. How 10 lakhs? It's really simple. I have shown you the calculation. 50,000 shares were subscribed into 20 exercise price, that's equal to 10 lakhs. Is it clear? 10 lakhs. And then employee stock option outstanding account, that liability we have to cancel regarding the ESOP, which we were recording and increasing year by year at the end. Okay, at the end of every years in the vesting period. Is that clear? So that we have to cancel. So how will we calculate that? It's really simple. Just take 50,000 shares into value of option. Value of option, that discount was of how much? Rupees 10. So into 10, that's equal to 5 lakhs. Is it clear? Easy. Okay. And then what have we given to them? Have we given cash or something? No, we have given shares, isn't it? So if you have given shares, yeah, if you have issued shares, then you have to credit equity share capital, isn't it? Simple logic. To equity share capital account, 5 lakhs. How is it 5 lakhs? It's really simple. 50,000 shares into the face value of the shares. The face value is rupees 10. Now don't think this 10 is value of option. No, this 10 is the face value. It's just a coincidence that, you know, value of option and face value is same. Okay, it doesn't always happen like that. So that's equal to 5 lakh. Okay, 5 lakh is the face value of equity share capital. And then whatever balancing figure will be there, that will go to securities premium. Yeah, here it's 15 lakhs now debit, and there is a credit of how much? Only 5 lakh. The remaining 10 lakh will be securities premium. This is how you have to take it. Is it clear? Or you can calculate 50,000 shares into market price minus face value. Market price was 30, right? Yeah, market price was 30 minus face value, that's equal to 20. So that's 10 lakhs. Clear? Okay, so this ESOP entry is also over. After this, we have to pass the, you see, there is a credit of securities premium now. See, first what happened? First we utilized securities premium to write off premium on buyback by 60. So securities premium was completely finished. We didn't have any money in securities premium. But then after the ESOP exercised, yeah, when the options were exercised by the employees, what happened? We got securities premium of 10 lakhs. Now we can utilize securities premium to write off premium on redemption of preference shares. Okay, that's what happened. But in the equation, I have done that in the beginning itself. Okay, but in the entries, you have to follow the proper chronology. It's better like that. Okay, it shows that you know how things work properly. Okay, fine. So securities premium account debit, it's a reserve now, so you're utilizing it to write off the premium on redemption. So you're debiting securities premium by 2 lakhs and you're crediting the premium on redemption of preference shares account, isn't it? Here it was debited now, so you are crediting it and cancelling it off. 2 lakhs, 2 lakhs. Is it clear? Simple and straightforward. Now you can have one doubt. Sir, why are we not passing the lapse entry? In the question, in this fourth point, they told us that 50,000 shares were subscribed. Yeah, employees exercise their option and they subscribe for 50,000 shares. What about the remaining? What about the remaining 50,000 shares or so? What happened to that? See, understand, the question hasn't specifically talked anything about that. Yeah, the question is not saying anything about that, whether they have been lapsed or something. And they are also not telling the exercise period. Yeah, if this was the last day of exercise period, then we could have passed the lapse entry, but we don't know what's the exercise period and all. Yeah, so that's why we'll not be passing any lapse entry. Okay, and the ICAI in the module also, they have not passed any lapse entry regarding this. They have just left it like that. Is it clear? So we'll not be passing any lapse entry. Fine. So this was the journal entries. These are the journal entries. Now let's just see the balance sheet. It's really simple, the balance sheet. Okay, right. Let's move on. Now see, it's really simple to prepare the balance sheet after the buyback, the post balance sheet. What you have to do is you have to see the cushion, and then in this balance sheet, in this cushion balance sheet, you have to give the effect of journal entries. That's all. And you will easily understand how to prepare the balance sheet after the buyback and all. Okay, so let's start. Let's see. Here the share capital was 120, right? So we had equity share of 100 lakhs and redeemable preference shares of how much? 20 lakhs, isn't it? So this 20 lakhs is completely gone. We have redeemed that, isn't it? See, in the journal entry, we have debited the redeemable preference share capital 20. So it's completely gone. So that will no longer be there. What happened to equity share capital? Understand. See the entry. Equity share capital got debited by 30 lakhs. So just take the calculator. 100 minus 30. Yeah. So that's equal to 70. Right. And then what happened? Equity share capital got increased by 5 lakhs because of options. Right. So plus 5. That's equal to 75 lakhs. So equity share capital will be 75 lakhs. Okay, see here, this is the new balance sheet. Share capital 75 lakhs. If you will see in the note, equity share of 10 each fully paid less cancellation of bought back shares 30 or minus 30 and then plus 5 because of ESOP 75. Is that clear? This is how you have to do it. Then see reserves and surplus. Note number 2, 118 lakhs was there in the question. See, we had capital reserves of 8 lakhs and then revenue reserve which is completely gone. Yeah, isn't it? What happened to capital reserve? See, something happened to capital reserve. Understand, there was profit on cancellation of own debentures, right? This profit on cancellation of own debenture has to go to capital reserve. Okay, so that's why capital reserve has been increased by 20,000. So this will be 8.2 lakhs. Okay, revenue reserve will no longer be there. It's completely gone. And securities premium, what will happen to securities premium? See, it's really simple. Securities premium was 60, right? And then we utilized 60 to write off premium on buyback. Yeah, and that was 60. So minus 60. Let me just show you. See here, securities premium was debited by 60. Yeah, so minus 60. So that became 0. And then in ESOP, we got securities premium by 10. There was a credit of securities premium plus 10. Yeah, and then we utilize securities premium by 2 lakhs. So minus 2, that's equal to 8 lakhs. Okay, let's see in the balance sheet. See here, reserves and surplus. Capital reserve was of 8 lakh and then profit on cancellation was added to that. So that became 8.2. Okay, and then revenue reserve is completely gone. It's nil. Okay, because we created CRR out of that. It's nil. Fine. And then what happened? Securities premium. See, securities premium 60 was their opening balance. Yeah, and then we utilized to write off premium on buyback, yeah, of equity shares, and then we utilized for preference shares minus 2, and then we got from ESOP 10. Yes, so that was equal to how much? That was equal to 8 lakhs securities premium at last. Is it clear? See, 8 lakhs. Fine. And we also created capital redemption reserve out of revenue reserve now. So that will also be there, 50 lakhs. Clear? Easy. So in total, that's equal to 66.20 lakhs. Clear? Easy. And then we have debentures. What happened to debentures? See here, we have debentures of 4 lakhs, isn't it? What happened to debentures? If you'll see in the question, we have debited the debentures and cancelled of how much? Of 2.20. So that 2.20 decrease we have to give over here. That effect we have to give. Okay. So if you'll see in the solution balance sheet, in debentures, there is a reduction. Yeah. 10% debentures, 4 lakh minus 2.20 lakhs. Yeah. Because we have redeemed now debentures of 2.20 lakhs. So that we have to subtract. So that's equal to 1.80 lakhs. Is it clear? Easy. And then current liabilities. In current liabilities also there is a reduction because of ESOP. Yeah, ESOP outstanding was included in that. So that's why other current liabilities opening balance 70 lakhs was there in the question, isn't it? If you'll see in the question, there was 70 lakhs in current liabilities. So in that there was ESOP outstanding account. So we have reduced that by how much? By 5 lakhs, isn't it? 70 minus 5. Why 5 lakhs? Because we have cancelled now. See here, employee stock option outstanding account in bracket. See here, current liabilities 5 lakhs. Okay, so that you will reduce. And then non-current investment. In non-current investment, we had investment in own debentures of 2 lakhs. So that also you have to cancel. Yeah, you have to reduce 120 lakhs minus 2 lakhs. Fine, easy. You understood now? It's really simple. Okay, so all that you will have to take. Okay, I have explained to you 1.80, that's the debentures, and then other current liabilities 70 minus 5, that's 65. Okay, the liability section is over. and then in asset there was nothing in PPE. PPE is as it is 50-50. Yeah, there was 50, now also it's 50. In non-current investment, what did we do? We just reduced the investment in own debentures. Yeah, investment in own debentures was of 2 lakhs, so 120 minus 2, that's 18 lakhs, 118 lakhs I mean. Okay, and then in cash and cash equivalents, of course there is a huge change. See, let's just do that. It was 142 in the question, right? So what did we do to that? If you will see the journal entries, we have paid to preference shareholders 22 lakhs. See, 142 minus 22. Okay, we have paid 22 lakhs, and then we paid to equity shareholders how much? 90 lakhs, right? So minus 90, that's equal to 30 lakhs. And then we got in ESOP how much? 10 lakhs. Yeah, so plus 10, that's equal to 40 lakhs. Okay, so from 142 lakhs, the cash balance after the buyback, redemption and ESOP is how much? 40 lakhs. So if you see in the solution balance sheet, it's 40 lakhs. Okay, cash and cash equivalents. Yeah, if you see in the notes to accounts, opening balance was 142 minus payment to preference shareholders minus payment to equity shareholders in the buyback, and then from the ESOP we got 10 lakhs. Yeah, that's equal to 40 lakhs. Is it clear? Simple and straightforward. Easily you can prepare the balance sheet. It's not a big deal. All you have to do is just give the effect in the old balance sheet. That's all. Okay, the main thing is the rough equation and all, and then journal entries. That's the main thing. Fine. So that's all for this video. I hope you have understood. It's really simple. If you have any doubts, then please comment down below, or you can also message me in Instagram. Okay, so that's all for this video. See you in the next video. Bye.